call the meeting to order. Roll call for the record. Present, Eugene Dugan, Fire Trustee, Chair.
Leah Hayes, Police Trustee.
Harvey Lewis, Trustee.
Cole Jacobs, WTW.
Walt Berry present via Zoom.
Greg Williams, staff.
William Johnston, staff. Bob.
Bob Fosner, hired help.
All right. Cool. All right. We have an agenda before us. Is there a motion to accept the agenda?
Motion to accept.
Second.
All right, there's a motion and seconded. Under discussion, all in favor, say aye.
Aye.
Any
Aye.
opposed? All right, motion passes. We have the minutes from June 21, 2023. They've all been dispersed to us ahead of time.
Motion to approve.
Second.
All right, there's a motion to waive the reading of the minutes. And a second? Okay. All right. All in favor?
Aye.
Aye.
Any opposed? Motion passes. Next on the agenda. All right, we're up to our attorney update with Bob Klausner.
Thank you. I did provide a memorandum to William yesterday for distribution to all of you about two lawsuits that involves House Bill 1645, which involves the Constitution out of a bill that really kind of regulates the Gainesville Regional Utility, but it has implications for us because it has the same language in it that House Bill 3 does that tries to, it says you can't make any decisions based on ideological, political, or social ideals, but of course all these statutes are exactly political, ideological, or social. So it's one of those sorts that cuts both ways. One suit was filed by a group of citizens, I think led by Joe Little, who was one of my professors at the University of Florida Law School 50 years ago. And God bless him that Joe's still here. So if I'm 70, and Joe was at least an adult when I was in law school, that means he's over 21 also. So the other suit is actually brought by the city. And the citizens group is saying, look, that Joe brought this as saying, I'm a bondholder and you're affecting the economic, you're interfering with my bond purchase because I bought it based on the way they run the utility system. And now the state is attempting to preempt the issue to itself in what's violation of the constitutional provision on home rule. The city brought a suit really for the same reason. I gave you the docket sheets if anybody's just thrilled to be watching this. I mean, it's 160 pages of lawyer talk. And, but there's some fairly substantial, there's some fairly substantial legal issues here. They're both in federal court. One was brought, there's a motion for preliminary injunction. In the city lawsuit, there has not been one, which in a preliminary injunction would just mean the statute stays on hold during the pendency of the litigation. This will be the first test of that ideological, political, et cetera, et cetera, et cetera, and the question of preemption. Preemption is where the state decides that it will regulate solely in an area. The most recent preemption case was really about the Police Bill of Rights. And the Police Bill of Rights, for example, is in Chapter 112, 532, Section 112, 532, and the City of Miami tried to change by ordinance what the rights were of police officers. And the Florida Supreme Court ultimately said, look, the legislature set the tone, and this is an area which the legislature could preempt it to itself. Interestingly enough, my little sunshine discussion before, the legislature said with regard to chapters 175 and 185, the state has preempted to itself. Because it says you can't have any, in the Constitution, you can't have any special acts about pensions, meaning local laws about pensions, that they've preempted that subject. So this is worth monitoring because it may ultimately let us know when we've been a victim of securities fraud. I was approached by a large firm that I've worked with a number of times, Kessler Topaz, which is located in Philadelphia, and they have requested the opportunity to also monitor Gainesville Police and Fire's portfolio. We just finished a case with them at the Firefighters involving Madison Square Garden, where Madison Square Garden, which as you may or may not know, was owned by a family, and the family created voting rights for its class of stock that the rest of us didn't have, and then merged another Madison Square Garden company that the same family also owned, and the pension fund got screwed in the transaction. And we filed suit against them on behalf of a class of retirement systems and actually settled the case for, it was just approved by the Chancery Court of Delaware for about $85 million back to the shareholders. So we were very happy about that result. I mean, it's a fine firm. When somebody monitors you, it doesn't cost anything. And you don't even have to do a case with, they bring you a case, you can do it with somebody else if you'd rather do that. I never think it hurts to have somebody monitor your portfolio, and in my view, having more than one or two is good for this reason. I sometimes get differing opinions about the merits of a case, and I like that because it enables, I don't do the underlying investigation. I read all the investigative reports. And by the way, any work that we do on a securities case, including from day one to the end, we don't charge the fund for. The securities lawyers' fees, if they are successful, they're all contingent, including the costs. And if they are successful in either negotiating or litigating the verdict, a case, the court sets the fee. We include our hours in that, and the lead counsel has to reduce their fee to pay liaison counsel like me. So this costs nothing. So my recommendation would be to authorize a monitoring agreement. I asked them to send me a draft to look fine. It basically says what I just said. You're under no obligation to do anything. And another set of eyes on our portfolio. On September 8th, I have one hearing in New York on behalf of the Sheriff's Pension Fund from Louisiana, also the Rhode Island Retirement System, the state of Mississippi, and the largest bank in Sweden, who are all major shareholders in Wells Fargo, and litigated against them for fraud because they started making new credit card accounts again for people who don't exist. After signing a court supervised agreement that they wouldn't do this, and the ink was dry, they started doing it again. But it's up for judicial approval for $1 billion would be in cash back to shareholders. So there's definitely merit to doing this, and if you authorize that, that's then the end of my report.
Bob, yeah, I mean, if the board wants to authorize that, they can also send, agreement language to me. We do have two other firms who monitor legislation. We use Pomerantz and a second firm I can't remember the name of.
I think you have, do you have Robbins? Get Robbins?
Yeah, we have Robbins Geller and Pomerantz.
Yeah, I mean, having one more isn't going to hurt, and, this is somebody who operates on the same high-end international level, so I think it's good to have a different, they have different perspectives about how to pursue cases, so I think it's worthwhile.
If you guys want to authorize it, then I can just handle the agreement and bring it to the board at some point at the next meeting or whatever.
Yeah, I think the way to do it is to authorize the chief investment officer to execute the agreement on behalf of the board.
We need a motion.
Yeah.
I'll make a motion to
Yeah.
authorize.
So there's a motion to authorize the chief officer to execute, what do we call it?
An agreement with.
Well, an agreement,
Litigation monitoring.
litigation monitoring.
Correct, it's just monitoring.
I'll second it. Under discussion, is there any worries about having stuff hacked because too many people have access to our, I mean, is our stuff public?
No, because all they did is, first of all, everything in your portfolio is a public record.
Right, that's, yeah.
They only have read-on rights on the investment.
We set them up to have view access to the State Street accounts. That's how they
Yeah, they have
monitor.
view access, that's all.
Okay.
They
But
can.
it's fine. We've got a couple of them already doing that.
Okay. It's not like Amazon has your credit card and then now that credit card gets, or that place gets hacked and now, okay. I mean, I'm sure it's all on the up and up, Bob. I trust your opinion.
Yeah,
I was just,
Yeah, it's not like my children who have one right now.
yeah. Okay. All right, is there any more discussion under the matter? Steve, are you up to speed on it?
No, so that's why I didn't second.
We can table it if you
No,
want
no,
to
no,
review
no.
it
No.
for next meeting.
No, monitoring is fine.
Okay. All right. All right, well, all in favor, say aye.
Aye.
Any opposed?
I'll take care of it.
Bob,
Unless there's any questions for me.
one additional thing, you did send a sample investment policy with House Bill 3 related language, and then also some language that would be recommended for investment manager agreements that are entered into after July of this year. I didn't know if you wanted to cover that briefly. And then I had kind of a follow-up question for you about House Bill 3.
Yeah, the reason that we included what you see on the screen now, this is for investment management agreements. That's because this ridiculous statute requires that this language be included. It basically says that they have to we have to inform them that they can't make any decisions based on social, political, or ideological interests, whatever that means, and I have no clue. I think what it means is this. That we can't make an investment because we want to save the whales. If we make an investment because we're going to make a lot of money and it happens to save the whales, that's okay. If we make an investment and the whales really don't like it, but we're going to make money at it, that's okay too. In other words, you can do, by doing well, you can also do good in the social sense.
Terminology in the policies.
You
Right.
just can't substitute doing well for doing good. And I have seen, for example, some real estate investment trusts had in their disclaimer language, it said we have this very robust ESG, environmental social governance policy, and they said they would actually sacrifice return to achieve their ESG goals. That would be illegal for a new contract in Florida entered into after July 1. And so basically they have to tell us that they're following the law. And that's what C is. It says they gotta basically write us a letter at the end of the year. And so to the best of our knowledge, I believe all of our investment practices have followed the law, period. And, you're not mom. And while you do have a strong due diligence responsibility with regard to their performance, it's their job to tell you what their thought process was. So, and the irony is in B, it says it can be unilaterally terminated. It doesn't have the disclaimer that's in 1. You can unilaterally cancel most of your investment agreements anyway, except some of your private equity deals or hedge funds that do have time limits in them or restrictions. The downside of this is I have spoken to investment managers, because we do this work in probably 30-something states, and they said, we're not interested in doing business in Florida anymore. It's too hard, and it's too hostile. And they don't want to be worried that a product that California is going to require them to do, which is including an ESG program in their investment philosophy, and it's prohibited in Florida, they're going to go, well, we can sell more cars in California than we can in Florida, so therefore, it's been nice knowing you.
Yeah.
So that's why I brought that gets back to my earlier report, that's why I brought the city of Gainesville case against the state and the taxpayer case against the state, because that's exactly what this is about. It's about whether the state's pursuit of an ideological bent in its legislation is actually going to chase away business to the detriment of the retirement fund. And the irony of this is, if we're restricted in our investment opportunities by virtue of this statute, and we don't make as much money as we could have made otherwise, guess who bears the cost? It's going to be on the city. And it may ultimately require a reduction of the assumed rate of investment return. Because if we are restricted in our investment opportunities, we may not be able to make what we're going to make. There was a similar bill to one called 662, to House Bill 3, that was considered by the Texas legislature, and we represent one of the largest statewide plans in Texas. And they were going to have to lower their assumed rate of return from 7 to 5.5 if that bill had passed. And the legislatures, when the legislature realized that meant they'd be appropriating a lot more money for pension contributions, they decided that, leave philosophy to philosophers. The Florida legislature didn't feel that way, and I'm going to be interested to hear what our consultant has to say about the reaction that they're getting. So this language is required to be removed. I think it's terrible. It's anti-business. It's certainly not, in my mind, if it was not required by statute, I think it would be bad fiduciary practice. But as fiduciaries who are bound by the law, that's one of the laws, this is one of the laws we have to follow, whether we like it or not.
And Bob, just to clarify a little bit, the sample investment policy statement that you sent to us, the language that's in red, that text is what you're recommending we add to our existing,
There it is.
to our existing investment policy statement, and staff can work with a consultant to amend that investment policy statement.
This is not the 10 commandments here. Much as I like to think I am divine access, but only in the God. But the point of this is that it's important that we reflect this restriction on us, because one of the things a fiduciary is required to do, remember, we delegate the actual investment decision-making to others, which is under Florida statute section 518.111 and 112, because that's what the sound fiduciary does, because I got like a smart board here, but you're not full-time investment professionals. But we have to inform the investment professionals in our investment policy statement, which the statute also requires, that our overarching policy has to be that it's money first and everything else second. And I think that we really are operating now under the philosophy that we invest for the highest and best return with a reasonable rate of risk. And if something socially positive comes out of it, great. If it doesn't matter. I know that the city itself, or either the city's money or for the general plan, had specific social goals that they wanted to achieve, either through the use of certain managers or investments in certain philosophically oriented classes of stocks or bonds, and that's actually prohibited now by the statute unless the fiduciary who is authorizing the investment can show that this is the one that's going to make the most money, or is expected to make the most money. Nothing is guaranteed in my business. So, and that's what it says in selecting managers on the pecuniary factors. So the manager comes in and says, listen, we plant trees in the front yard of our office every year to make the air cleaner. You can't consider that. But if they say we make a boatload of money and we use some of that to plant trees in the yard, that's great, because you're operating on a pecuniary factor, and that anything else that happens as a collateral consequence doesn't need to be considered nor to run account of the statute. So I am recommending to you that staff be authorized to work with the consultant for both the language to be included in the IMA and the changes to the investment policy statement, because I believe we're required to do so.
So we'll do that and bring it back to the board for
Yeah, I think that would,
approval.
ultimately the board has to move to approve it. The sample IMA language, I think, is right out of the statute, so I'm just worried it's gonna scare business away. And that's not good. It's not good for the fund, it's not good for the taxpayers.
How long, do we want to do this in September or October? I'm going to be in Germany in September.
Well, I mean, I think the investment policy language is pretty straightforward unless Willis Towers Watson finds any issues with it. I think it's just adding some language and you know, unless a board member has an issue with it, I think it's something we have to do. We're going to be doing this on both plans.
I don't think it's any different than some of us had that language that said we're not gonna do business with Iran or North Korea.
Right.
Or any of the other bad
Did-
actors.
Did we need to look at our policy versus where we are on our percentages to make sure we're in line with our policy?
We'll do that at the same time.
Right.
We'll do it all.
Okay.
We'll do like the annual review.
Which meeting are you gonna do this?
Probably the next meeting in
October.
September.
I won't be here September, but if y'all
We
want-
don't have an October meeting
Oh,
right
that's-
now unless it's.
Oh, it's November, correct?
Yeah.
That's right.
What is the date of the meeting in September?
I got to flip ahead on my calendar
I
here.
think it's on the agenda as the next meeting.
Oh,
Is it the last week of September?
September 27th.
You know, that's during the State Division of Retirement's Police and Fire School, which is gonna be in Orlando. You would consider moving the meeting a week early. I'd like to come in person.
2 weeks early.
For the September meeting.
2 weeks early and I can make
I
it.
think it's gonna be a robust discussion, and I think I'll be able to offer more if I can be there in person.
Would
Is that the-
you rather do it in October so that you have feedback
If you
from
do it in
them?
October, there's no problem. I can be there. So
Something you can make, October.
that gives me enough time to move stuff around. What is the date of
And likely my likely successor will be there too.
So, do we need to move to the October or just,
We can
Yeah.
continue to do the September meeting and add an October meeting, or we can move the September meeting to like the first or second week of October, whatever is the board's pleasure.
I can take what this board member's pleasure is, because the way my September is, I would prefer to just do one early in October so that.
So we'll move the September meeting to
chair
the
can
first or second week in September. I'll send out some dates and get feedback, and we'll get that scheduled.
So you're talking about moving it to the week of either October 2nd or the week of October 9th, right?
Correct. Would that work for you, Bob?
I am available either week.
Okay.
I presume you're going to keep with the Wednesday, correct?
Yeah, we'll do it on a Wednesday.
For the 11th.
Okay, so I can be there for the 4th, I can be there on the 11th, so it'd be nice to see everybody in person for a change.
Okay, the only thing that may impact is that September 1st is the deadline for the investment consulting RFP proposals, and we were going to bring those to the September meeting, but I don't think it's an issue because we don't have to follow city policy. So even though the RFP says that we'll bring a short list to the board for review in September, we can just shift that a couple weeks.
Yeah, I don't think that would be material. I'd be interested in seeing the proposals of those who are on the short list.
Right. We'll send it out to you, Bob.
Okay, great.
I did have one sort of side question, and I don't want to keep it too long, Bob, but my reading of House Bill 3, when I read through all of the language, I know we've been focused on the pension plan investment statutes, but it also, to me, appears to apply the same prohibitions and restrictions to operating fund investments, to banking services, to debt issuance,
Yeah, I think it's intended to do that.
and even procurement. You know, even citywide procurement, it seems to prohibit ESG in that. And I wonder, do you think that includes like small, local, minority, and veteran businesses?
Well, you know, it's interesting, the U.S. Supreme Court kind of did away with that in colleges. got rid of, DE&I, diversity,
Equity.
programs, equity and inclusion, which I think is important. I think you can say that that will be a factor to be considered if and only if you are otherwise demonstrate that you offer the best pecuniary result. You can't say, I want to hire a local firm. At least the philosophy behind the statute is to preempt from you the ability to say, well, we want to give a Gainesville or a Alachua County business or a minority-owned business a preference. But you can apply that after you get to the pecuniary line. That I think is permissible. But,
And
I think it's the right thing to do. I have other funds with very robust, DE&I procurement rules, and this is intended probably to interfere with that. But as long as you can say that from a monetary standpoint, they are expected to be an equivalent performer, then other factors can be considered.
And the city attorney's office may end up reaching out to you to discuss some of these issues. I've kind of prompted them a couple of times now to review HB3, just, and how it applies to other things besides pension investments.
Right. Well, I see the city on the GRU suit, they hired Cindy Laquadera who's with Ackerman in, I'm assuming she's still up in Jacksonville.
Yeah, Jacksonville.
We had a long and very successful working relationship together when I was doing Jacksonville Police and Fire, where they decided not to have a real pension plan anymore. She's a fine lawyer and an ethical lawyer. I like her a lot. And I think that would be the person that the city attorney ought to be talking to about addressing this issue as well. Because from her reading her writings on the GRU suit, she's got it, and she gets the point.
Okay.
Okay.
Thank you.
Thank you, Bob.
All right. It's good to see everybody, and I will look forward to seeing you in person in October. I have marked out both days on the calendar, and I'll be there one of them.
All right.
Thank you.
Take care.
So
Thanks, bye.
it's just language issues, right?
On the investment policy
Well,
statement?
not just, but the city, policies on business.
Yeah,
No.
it's just, allowable investments in how you evaluate service providers. Because when it comes down to procurement, and like I said, to me, it reads
But it's
like
not just pension.
it's banking services,
yeah,
it's
everything.
debt issuance, it's
Right.
licensing, it's all procurement
But
citywide.
wouldn't local business could be seen as a positive pecuniary factor because your money stays?
Well,
right?
that's the rub, is it?
But if you say that first, and then you say we're looking
Right.
for these other things, I think you said that's all right. But it's
Yeah.
all probably just got to rework stuff,
Yeah,
right?
well,
Before someone
and
sues you for it.
you want an attorney involved.
Yeah.
Right.
Right. Interesting. A lot of stuff.
Yeah.
A lot of work. All right, where are we at?
September to October.
All right, next item on the agenda, presentation by Parametric Portfolio Associates. You got them online here?
Yep.
I can't read the name from here, I'm sorry.
I think you guys are on mute. Jason, you're muted.
This is Jason, Parametric. Can you hear me okay?
We can, thanks.
Great. So we're all good to go?
Good to go.
All right, thank you. So my name is Jason Chalmers. I am on the client service team at Parametric. I have a couple other colleagues on as well. Ryan Swanson, who works with me, who's just listening in on the call, as well as Mackie Anderson, who's a senior person on our overlay services team and a portfolio manager there. So you'll be hearing from him. But just before I pass it over to Mackie, I want to just provide a quick sort of background update on Parametric, if that works for you. So before I dive into that, I just want to thank you guys. I know that the plan has been a client of parametrics dating back to 2015, so we want to thank you for that long-standing business and appreciate the relationship. So just a quick kind of background on parametric, what we do, where we are, what we manage for assets. So we offer systematic and customizable solutions for clients, and that ranges across equities, fixed income, and derivatives. You folks utilize our overlay services group of strategies, which uses derivatives, namely futures, to gain exposure to markets for you that otherwise your cash wouldn't have exposure to. So it's just a sort of an augmented approach to your cash investing, again, to help some other asset classes like equity, international equity, fixed income, etc. So we have about 870 employees across the country with several offices. Just under 400 of those 870 is in our Seattle office, where we manage largely equities out of that office. We have about 150 people in our Minneapolis office, or Mackie Hills of, which is where we manage our derivative type strategies. And then between Boston and New York, we have about 160 folks, which is where we manage fixed income solutions, and it's also, those are hubs for client relations and consultant relations. At the top level for the firm, we manage about $440 billion in assets. Of that, about $185 billion is for institutional clients like yourself. And we manage within the overlay services, which are invested in, about $130 billion. So it's a big, this is a big piece of our business. One that dates back, parametric dates back to the mid-80s, so over 30 years. 30 years of business, and we've been working at this overlay strategies for years and fine-tuning. We think that we're the leader in the space. So again, thank you for having us today. Appreciate your business. And unless there's any firm type topics that I didn't cover, I'll pass it over. Just let me know.
Great, yeah. Thank you for having us today to present and review the overlay program. It's a great opportunity for us to be able to share. If you want to go to slide 10, that's kind of where we move on from the kind of general overview of parametric and start talking about the overlay services in particular. High level, what we're doing is trying to help efficiently implement the asset allocation and the goals that Gainesville has set. We expect to improve the return of the portfolio, help manage risk and tracking error in the portfolio, and to do all of this in an efficient way, oftentimes more efficient than some of the physical management portfolio. So I'll get into on that. The reason this all works is the third bullet point here. The futures that we use for the program are highly efficient to trade. They have very low trading costs. And as unfunded instruments, they allow us to have a relatively small amount of capital in our portfolio, in our accounts, I should say, but to have a bigger impact on the portfolio as a whole. So, a small amount of cash to support all of these different services we'll review today. That's kind of the key that makes all of this work. If you want to go to slide 12. One of the things that pretty much all of our clients are seeing is that they have to hold some level of cash on an ongoing basis. All plans have cash needs, whether that's benefit payments, a pool of cash for capital calls, for future commitments, operating cash flows, etc. That cash will represent a cash drag in the portfolio. It's not invested, it's not earning a market return. And in the absence of parametric, this would be a drag on performance. Now, if you expand that principle to some of the separately held managers in the portfolio, we're talking about disciplined growth investors, the LSD accounts, and SGA. We're actually picking up a small amount of cash in those accounts too, and investing that cash as well. So the cash overlay is really focused on reducing that cash drag in the portfolio and making sure that the portfolio is fully invested in the asset allocation that you've set with your actuary and your consultants. We are implementers of that kind of schematic. The last part here is that we monitor the entire portfolio daily. So all of the investment managers, we're looking at every asset class, and to the extent that the asset classes deviate over time meaningfully from the target allocation, we will step in to synthetically rebalance the portfolio back to those targets. Again, reducing tracking error, keeping the portfolio where you designed it to be. That's the very high level overview. If you go to the next slide, slide 13, we are, this is kind of describing our daily process here. We have a direct feed into the custodian, and we're getting all of this data daily for each investment manager, for the entire portfolio. We're reconstructing the portfolio and monitoring it. We have thousands of risk checks that are going on in the background. We're looking at things like cash flows. We're reconciling pretty much all the cash flows that we see. If there's a cash flow that jumps out to us as looking unexpected or strange, we'll reach out to the bank, we'll reach out to the consultant, we'll start Watson here, and confirm that data. So we are, as much as we are an investment management company, we also think of ourselves a little bit like a fintech company as well. And that our system is proprietary in nature. It's been built to do exactly this, and we also have the investment staff. So my team of portfolio managers that I lead are portfolio, and also our investment analyst team are reviewing all this data, scrubbing it, and eventually kind of recommending all of these different trades. Next page, page 14. This is kind of our overview of the cash overlay in the portfolio. So this is one of the sources I mentioned. I mentioned we monitor the cash exposure. To the extent that, say, cash comes into the portfolio, we will be investing that opportunistically in the asset class that is most underweight. So, for each cash flow, we are looking to use that to implement a smaller rebalance, if you will, just to push whatever asset class needs it the most back to target. Vice versa, when there's a cash outflow from the portfolio, say you've paid benefit payments or sent out a capital call to a manager. In those cases, we're selling in the most overweight asset class in the portfolio. So even day to day, we're monitoring each of these imbalances and sort of pushing each asset class back to target in an opportunistic manner. We expect that cash being invested over time is going to increase the expected return of the portfolio. I say the second bullet point there, reduce transaction costs. This comes into play. Many of our clients feel that they can sit on a higher level of cash, knowing that it is invested and not sort of experiencing a cash drag in the portfolio. Being able to make those physical redemptions for cash requirements less frequently is a way to reduce transaction costs and sort of also reduce the amount of work required to make those, whereas before you might have done cash raises monthly or quarterly, now you can raise cash less frequently and sit on a higher level of cash. It improves liquidity in the portfolio and also gives you a lot more flexibility in where you want to raise cash from as the portfolio is managed. We have this graph of cash exposure here. This is the cash that we've observed in the portfolio over time. A couple of bigger spikes there just for ongoing or just for kind of one-off redemptions and fundings, the occasional bank contribution as well. The red would be the actual cash that we observe, and that average bar there, at about 13 million is the average level of cash that we've seen in the portfolio dating back to 2015 and the inception of the program. Now, in that chart at the bottom right, I love this comparison. If you look at the actual cash average of 5.15%, that's the cash that you've been sitting on the portfolio. After the overlay, that effective cash level of 9 basis points, or about 230,000, is the effective level of cash after the overlay program steps in to invest that cash. daily or whenever that cash comes in. On average, that's about where the cash is bound for, 230,000. So showing exactly how much cash we're investing over time, and I think that's one of the main keys to the program here. I'll pause here. Any questions just on the cash overlay portion or in the overlay in general so far?
I had a question for you concerning the rebalancing to target. Did you say you guys do that on a daily basis?
So the cash overlay is a little bit of a rebalance daily. If cash comes in, we'll buy in the most underweight asset class. That's done daily. The rebalancing with predefined thresholds is typically done on a monetary basis. So we're looking at each asset class, and we're not actually stepping in to enact a full synthetic rebalance of the portfolio until asset classes have deviated meaningfully from target levels.
Okay, so if a particular asset class is outperforming for a period of time, sometimes people let it run. You're not immediately taking that off the table. You're doing that only if it gets outside of a range.
Precisely, yep. So yeah, going to the next page here, that's perfect. Ties right into the next slide. So this is the rebalancing overview here. We've kind of constructed the portfolio with Willis Towers Watson to these 4 asset classes to mirror how you're thinking about the portfolio. Each of these asset classes is allowed to run, to use your terminology, about 8% on a proportional basis relative to the size of the asset class. So, here, domestic equity, for example, at 6/30 of this year, it was about 2% overweight to target levels. We would let that run to about 4% before that triggers a rebalance, and we're stepping in to add, or in this case, remove futures exposure in the domestic equity asset class to bring that down to target levels. We'd be stepping in to invest, into an international equity, fixed income, and real estate here, just how the position was, the portfolio was positioned at 6/30 at least. But yeah, so we're waiting for the exposures to trip those bands that are kind of noted in the darker gray color here on this graph for this chart. And then stepping into rebalance all of the asset classes back to target. So, it's not necessarily a selling point of ours that the rebalancing program will add value. Typically, we're more focused on tracking error here. That being said, what we have observed over time is that a disciplined rebalancing program has tended to add about 10 basis points to the total portfolio on average across our client base. So, letting asset classes run a certain amount and then rebalancing, capturing those meaningful deviations over time between the different asset classes in the portfolio has tended to be additive, as is the case here.
Mackie, how much has the portfolio benefited from having this cash exposed to the markets since you have been working with the portfolio?
Yeah, great question. And next slide actually is going to be a helpful one to sort of do that. So you're following along my presentation perfectly. So the portfolio has been significantly benefited by having the overlay in place. So this dates back all the way to 2015. You can see nicely additive, inception to date, adding about 6.8 million to the portfolio. On an annualized basis, that's about 37 basis points gross of parametric fees. Net of parametric fees, that's like 34 basis points. We are a low-cost overlay provider, and so the benefit to cost has been tremendous here. Even all quarters here, June quarter to date, year to date, highly additive. All of these percentages I wanted to denote are relative to the total fund, so they would represent what we've actually added to the fund, not necessarily like a traditional manager return where you're looking at, they returned 5% this quarter. The denominator we would typically be looking at is the total fund. Now on the bottom left here, this chart is kind of how well are we doing relative to what an overlay manager should be doing in this situation. So this is a graph showing how closely our futures exposures are tracking basically what the benchmark is in the portfolio. So very tightly over time, you see a little bit of divergence, you know, accumulated over, say, over 8 years here, but, tracking that benchmark very closely. And, lastly, you can see the total exposure comparison on the bottom right. This is another representation of, where is the portfolio positioned on a physical basis with just the investment managers, then where are the overlay exposure position, and net of all of that, where is the total portfolio position with the overlay exposure. So much more closely on target. You'll see cash, especially going from this is as of 6/30, so going from 2.8% down to functionally 0. That's the key selling point of the cash overlay program, but also all of the rebalancing exposures as well, pushing each asset class much closer to target, and really reducing tracking error to the plan benchmark. The last item I wanted to mention here is transition management. We don't have a slide on it. We don't actually have any transition exposures on at the moment, but definitely something we've helped with over the years here. The simplest example of this would be, you're redeeming from manager A, you're going to fund manager B, but perhaps there's a gap between when that can be arranged, right? There could be funding dates, there could be certain dates where you can actually fund the new manager. You may not receive cash from the first manager for quite some time. So what we can do is step in and bridge that gap. So say we're moving from an EM manager to another EM manager, we can step in and add MSCI EM emerging markets futures to directly plug that gap, keep the plan fully invested from a cash perspective, but also right on line with the targets in the portfolio as well. These can be events that tend to add to meaningfully to tracking error in the portfolio. They can be one-off, they can be very large in nature. These are definitely things that we can help out with. We can communicate with both managers so that we are adding exposure when manager A is selling out of their portfolio, and remove our overlay exposure, our futures exposure, in line with how manager B is investing it on the backside. So very tightly coordinated with all these managers. The synthetic transition management is something that we excel at, and have done over the years as well. That's kind of what we have in place today for the plan. Happy to talk about other stuff we can do. If you have any questions, I guess I can open up for questions there.
Any questions? I don't think we have any, boss. Thank you.
Great, thank you all for the time today, and again for your business. We really appreciate the long-standing relationship.
Thank you. Thanks.
Take care. Thank everybody. Have a good one.
Wait, they just rebalance the cash exposure. A little bit they can do.
They're rebalancing asset exposure, style exposure as well, equities, fixed income stuff, but within ranges. They're not like doing it every day back to target. They have an 8% range that they'll rebalance.
That's all that runs only the floating cash.
Right. That's the only thing they have access to. Interesting. I didn't realize that's what they did.
Yeah. Since markets tend to go up over time, having that cash drag will kind of hurt you. But as you saw with them, like they've made you over like $6 million because they're just investing that. It's not costing you much.
And some of those spikes you saw in the cash, like the one in 2020 was related to the pension obligation bond, depositing that money, things like that.
Yep.
So if the domestic equities, if because you're getting such a high return, your percentage of your portfolio is shifting that way, they will start to sell some of the millions in cash into something else, or buy something else. I mean, domestic,
So you
or
actually
international, or
so you still have, so on average, that $13 billion in cash over the last 5 years, you still have that exact amount in cash.
Right.
But synthetically with futures, they are exposing that cash to the markets. So you still have it, but it's earning you money in the futures markets, just like an equity would.
So
And
they're
is
buying
that-
futures on the S&P 500 or a fixed income
But
future.
to be more in line with our policy,
Target.
Yep.
Right.
target,
Yep.
because we started shifting one way or the other.
Mhm. Just
Interesting.
a nice thing to have in place, yeah.
Take a few $1 million.
All right. I think you're up next, Cole.
I think so. Good to see you all in person. Pretty standard update from me today. I'll review capital markets and plan performance, and per usual, please jump in with any questions. I'll start on slide 4. So this is looking at a capital market update through June. I'll also talk about what's happened in July and August as well. But in the top left, you can see really positive results in the fixed income market so far this year. For the second quarter, S&P 500 returned 8.7%. And for the year to date, that's up almost 17% for the year. So really strong equity market returns. We saw a lot of volatility early in the year as it related to some banking sector instability. But the market's kind of plugged on and delivered really strong returns. Through yesterday, the S&P 500 is up 15% year to date. So down from 17% to 15%, but still really, really strong returns so far this year. On the right-hand side of the page is the fixed income markets. You can see that year to date, positive performance. The quarter was slightly negative. Yields did tick up just a little bit, and they've ticked up even further so far into July and August. Another about 40 basis points. So we're going to see your kind of plain vanilla bonds, which you don't really own any of, will have a little bit more negative returns so far in July and August. But the high yield down at the bottom is kind of more aligned with what you own. There's really kind of no change from what you see there to where we are today. So still up kind of that 5 to 6% range year to date. In the bottom left-hand corner of the page, looking at some various economic factors here. Headline inflation has come down from 9.1% a year ago to 3% printed here. Through July, it's actually 3.2%. So that's the annual rate of inflation change. Still above the Federal Reserve's target of 2%, but it's not 9%. So it's certainly
It's
coming
not
down.
9% on top of 9
Yeah,
before.
exactly. So it's moving in the right direction. This year in particular, it's been really helped by energy prices have come down a lot. So that's helped kind of dampen inflation a little bit. But we do believe that inflation will be stickier. You're still seeing wage pressure. So hovering around that 3.5% range is probably more likely for the foreseeable future, but more sustainable than close to double digits.
And these numbers were as of June 30?
They are, yeah. So GDP growth, we show 2% here. That's for the first quarter. The second quarter GDP growth was 2.4%. So for both quarters of the year, we've seen positive economic growth so far. So that's certainly strong, pretty consistent with long-term 2% average. And unemployment continues to remain very low. We show 3.6 here. As of July, it was 3.5. So certainly very low unemployment, which has been fairly consistent over the last few years. On the bottom right-hand side of the page, you see the yield curve. That purple line at the very top, which is actually off the charts now, is the current yield curve. As you know, the Federal Reserve just continues to raise their discount rate on the short end, and that's why it's now off the chart. It's at 5.25 to 5.5%. The remainder of the curve is pretty flat. The Federal Reserve has indicated that they're probably going to pause for the foreseeable future. Some of their minutes indicate that they might raise again. Market pricing says they're going to pause for the remainder of the year. So we'll see what that looks like, but certainly a very fast, historically fast hiking cycle from the Federal Reserve. Any questions on what's been going on in markets?
Very positive.
Yep, so far so good. And if you go to the next slide, you can see your plan performance, and it's the plan has benefited from from these strong capital market returns as well. So year-to-date, the plan is up 10.3% versus 8.2% of the benchmark. Fiscal year-to-date, so we're 3/4 of the way through the fiscal year, the plan is up 18.6% versus 14.7%. So really, really strong returns, both year-to-date and fiscal year-to-date. Most managers in most segments are contributing to this. So if you kind of go down the line, I'll look at the fiscal year-to-date column. The domestic equity segment returning 25 and some change percent, slightly ahead of its benchmark. LSV is doing well. Sustainable Growth Advisors there, that's your growth manager. 26.5% return, which is strong, but it is a little bit underneath the benchmark of 31.8%. The second quarter of the year in particular, technology stocks kind of fueled by this artificial intelligence momentum really just, they took off. So SGA owns, they own a lot of Amazon, a lot of Apple, a lot of Microsoft, but they don't own enough of it. They limit their ownership to 8%, and both of those index weights are in the double digits. So just not owning enough kind of hurt them, but still up 26% fiscal year to date. Small cap has been doing really well. You can see there, fiscal year to date, the segment is up 28.5% versus the benchmark of 14.8%. So they're crushing it. Both LSV and Disciplined Growth Investors are doing really well. LSV up 19.7 versus 11.1, and DGI up 36.8 versus 18.2. So really benefiting. DGI does kind of play in the technology sector a lot more than some of the others, and so they really benefited from those tech names just taking off this year. Lastly on this slide, Mower International Equity. The past couple meetings, their numbers were slightly below the benchmark. Now they're above across all periods under review here. So fiscal year to date up 27% versus 25. Year to date up 11 versus 9.5. So they really turned it around, and they're performing really well. Moving on to the income segment, fiscal year to date, from an absolute perspective, isn't as rosy as the growth segment. They're up 2.2% at the segment level, but the benchmark is down 2%. So they've added 4% of alpha here, and that's all really coming from the real estate segment, particularly the two Harrison Street funds. So I'll get to them at the end here to talk about the alternative credit. All in all, the alternative credit segment is, it's still doing what it's supposed to do here, kind of in line with their benchmarks. Ares up 8% versus 9.5 for the fiscal year to date. Year to date, they're matching their benchmark. One Sharp, which is the largest weight here at 6%. The rest of these are 2 to 3%. And One Sharp's that same manager. I always call them out each time because it's just a very steady kind of 7-ish% a year return.
Why does it show so low for the last few months?
So
I noticed that last meeting. I was
it's
wondering.
always going to look like that because they earn kind of that 7% per year. So if you break it down to just 1 quarter, it would be a quarter of that 7%. So it's just a real steady 7. So over the last 1 year, you can see they're at 7.7, and 3/4 of the year, over fiscal year to date, 6.4. So kind of on track to reach a little over 7%. The real estate segment is, the benchmark itself is down 11.2% fiscal year to date. And that's largely driven by write-downs that we've seen in the office sector in particular. The whole work from home dynamic is really hurting valuations in the office sector. It's not really a surprise. The principal property fund there is doing exactly what it's supposed to. It plays in those kind of 4 main food groups of real estate. So office, retail, family housing, and I forget the third, but so it has exposure to the office sector, so naturally it's going to kind of follow that benchmark a little bit more closely. The 2 Harrison Street funds, they're supposed to diversify the principal exposure, so they're having all kinds of real estate and infrastructure exposure that are not in those 4 main food groups. So the office deterioration hasn't hurt them because they don't own it. So fiscal year to date, the core property fund is essentially flat when the market's down 11.2, and the social infrastructure fund at the very bottom is up 5.3 versus being down 11.2. So they've added 16.5% of alpha over the last fiscal year. So the portfolio has really benefited from having that diversified exposure in the real estate space when the rest of the market has been down. So it depends on what time you're looking at them. The core property fund did have a lot of senior housing. So during COVID, that did get hit. So do want to acknowledge that, but you can see their long-term numbers. I mean, they're beating the benchmark. Turning 8.5% over 3 years. So just really, really strong performance in the real estate segment.
If you had to take a stab, Cole, where are we at as of total plan fiscal year to date?
Let's see. So
This is what, June 30th?
June 30th, and we're
July.
halfway through. So July was positive, and then August has kind of been a little shaky. They probably net each other out. I would say you're probably pretty close to where you are printed on the slide right now.
So we only got one more month to go, and then we lock it for
We
the.
lock it for September. Yeah.
We're just trying to hold our
Six
breath.
more weeks to go. Yeah. So far, so good.
Well, it's been a good summer, a lot of summers, you
Yeah.
pay for it being in the market, but
Yeah. I
Just
did.
change our fiscal.
Yeah.
set it for June. With Nuveen, I know that some managers, are not allowing, new money in or money out. They're probably still locked up until there's less volatility in real estate.
Yeah, I keep checking with them, and they keep saying, you're in the queue, but we're just not drawing down any money right now.
And that's okay.
Yeah.
I'm fine with not putting money in real estate at the moment.
Right. Now, they're in the industrial sector specifically, which has, been doing really well, but I think just all the volatility we've seen, they're being cautious right
Sure.
now, so.
How much are we buying that? Do we know the ballpark?
I think it was
Just curious.
4% of the portfolio.
Okay. So
And it
around
may not-
13 million?
It may not be taken all at once.
Probably not, yeah,
Okay.
probably come in a tranche or two. Yes, you've been in the queue for over a year now, which is longer than they expected, but given the volatility in the market, I think they're just being cautious, so. Certainly fine with the managers that you have now, but if and when they draw the capital, it'll be beneficial too, so.
I look at the alt credit and like fiscal year to date, they're doing good. If you look at since inception, one sharp, so when it stands out, how much lost opportunities there?
Yeah, so what really happened was, last fiscal year, 2022, typically when equities sell off, fixed income does well. That there's a negative correlation between the two asset classes. There's only been 3 years in the history of markets where they've both gone the same direction. And last year was one of those years, like 87 and 65 were the other 2 years. So they almost never go in the same direction. It just so happened they did last year. Yields, skyrocketed, equities sold off. So, the plan still benefited from having them last year. So I went back and looked. So the fiscal return for 2022, when everything was negative, the plan was down 15%. But your growth equities, or your growth segment, was down like 23%. So they added value in dampening that volatility. They're intended to.
No, I agree with that, but I was at what cost? What about the other 3 years?
Yeah, over a full market cycle, we would expect them to add value to the portfolio, and so it's kind of just bad timing. So you see that 2018 is when a lot of these were added. 2022, so 3-ish years later, we saw some of the highest rise in yields that the market's ever seen in such a short period of time. So right now, all of these funds, regardless of what the market does, if the market just stays where it's at, the yields on Aries the yield to worst is like 9.7%. Libra Max is in the double digits. One Sharp is earning their 7% a year. And the fallen angel strategy is going to be the same as Aries, so 9.7%. So if the market doesn't change, yields don't go anywhere, they're going to clip a coupon of almost 10% for each one of these managers. So we think that's beneficial to the portfolio, and there's less volatility here. So, certainly it hasn't been, the perfect market environment over the last 3 years, but we do still have, a lot of conviction here. And it's important to just diversify across income streams as well. I mean, you get an equity risk premium from 70% of your portfolio, getting an income risk premium from this piece of the portfolio of just 30%. It's beneficial, we think.
Any other questions?
Klaus's proposal, the year-end report on the ESG,
That has-
handles that.
We don't have the rules on that yet. The Division of Retirement and Department of Management Services haven't published those rules. So we will see additional changes to the IPS probably in the fourth quarter. The reporting is required in December of each year. So we assume they'll have the rules ready before the reporting's required.
The lawsuit's going to be settled by then.
Yeah, so this is just kind of like the first phase of the language requirements that we think are necessary for the IPS and if we, and any new investment manager agreements, but there'll be some additional changes later this year. And, we'll see, I think we'll have to talk to individual managers about how we can facilitate some of the requirements. There may be, we may have to add a service provider who can do some of the proxy voting reporting for us, that sort of thing. So we're still kind of just in the holding pattern, waiting to see what the state comes up with.
Now, I didn't read every bit of it. Is it mostly under 212 or is it 175, 185 also?
It includes 175 and 185
I'm just looking at
language. It includes language, like I said to Bob, it includes banking services, debt issuance, operating fund investments, general procurement, all licensing. It hits dozens of Florida statute chapters.
I'm just looking to have all the I's dotted and T's crossed when it comes to 175, 185, like you don't want to get into, they hold it for another year and a half.
Yeah.
Oh, so we're not in line with the, yeah.
Almost like they look for an excuse sometimes.
Mm-hmm. Yep. All right.
I would give the board just a quick update. September 1st is the deadline for us to receive the investment consulting proposals. And, we had intended to bring a short list to the board on September 27th, but that'll get pushed back to the October date that we're pushing that meeting to. Just as a way of an informational item, we had over 30 firms download the RFP from the Demand Star website. I really hope only about half of those submit proposals, so we'll see how that works out.
All right. Are you taking off, Cole?
I think, are you guys,
Yeah, we're about to adjourn, but
Okay.
yes. Well, thank you,
were talking
appreciate
about
it.
RFP, I didn't want to.
I think you're okay.
Yeah,
Yeah.
Great to see you all in person.
thank you.
We'll see you again
Thank you
soon.
for the presentation. Okay, so I'm flying in October 5th. If we could do the 11th, if that's okay with everyone else.
We'll shoot for that.
I'm good on the 11th.
We'll shoot for that.
That's fine with me too.
All right, perfect. And I assume Willis Towers Watson is on there?
They are. We sent Willis Towers Watson, you can specify a list of firms that the proposal or the RFP is sent to directly, and so we had them sent one directly. The other firms had to go to Demand Star and download it. But we also advertised it in Pensions and Investment Magazine, so that all the big firms, Wilshire, Russell, Callan, Cambridge Associates, all these really big national firms downloaded it. So we'll see if they propose.
Oh, so we won't, yeah, okay, so by October though, we'll see if they have a proposal, right, or draft.
By September
Sure,
1st,
let's
right?
take-
September 1st is the deadline. They typically come in within a day or two of that date. They typically, all come in at the last minute.
Mhm.
So we haven't gotten any yet. We haven't gotten any
Should,
proposals.
well, what I'm trying to plan October, are we gonna plan on, or try to go through them and grade them at
So
the actual meeting?
the way the
or-
board voted previously was to have staff do an initial review.
Right.
And bring a short
Right.
list to the board.
Trim it?
So we'll bring you, we said 3, but if we get 15 or 20 proposals, we may bring you a short list of 5 or 6.
Okay. Makes sense.
It just depends on how many we get, and whether, if there's a big disparity between the top 3 and the rest, it kind of depends on how they fall out, what the quality of the proposals is.
Okay, and are we, oh, that's fine.
And then in October, the board can either decide to select a consultant from those proposals, or they can request those firms to come in and do oral presentations at a later date. That's up to the board.
Okay. All right.
I just have a general question, you don't need to answer it, just at some point. The cash flow kind of procedure, are we gonna keep a look at that over time to see how it impacts our plan returns, where you're having to execute trades based on,
I mean, the quarterly withdrawals.
yeah, versus,
I mean,
yeah, I'm just
I'm
kind of.
not sure how accurate it'll be,
Yeah,
but I can.
I am kind of curious to see over time.
Is this the parametric?
No, this is,
I'm sorry.
so internally with the city, we used to allow the
Yeah.
cash locally to go negative.
Mm-hmm. Paid it all at the end, right?
And our new finance director doesn't want that to happen. We do one big withdrawal at the end of the fiscal year to bring it positive for year end, for the fiscal year end financials. The finance director now doesn't want that cash balance at the city to go negative at all. So I'm doing quarterly withdrawals. So instead of doing like a 15 or a $20 million withdrawal in September every year, I'm doing like $5 or $6 million withdrawals every quarter. So my initial analysis of that is, if you assume the plan is going to earn its long-term rate of return of, say, 9%, 9.5%, over time, it costs you money to do that, because that's less money invested. And I did an original analysis when she wanted us to do this, and said, look, it's going to cost the plan, my analysis was it would cost the plan about $1 million a year in investment returns. But she's an accountant, and she wants to follow certain accounting best practices, and the city manager agreed with her.
Biannually, maybe, twice a year? 6
She
months?
wanted quarterly.
Quarterly, and she
Yeah, the more you take out in that.
She damn near wanted monthly. And you guys aren't involved in moving money around with State Street,
Sure.
but it takes about a month to get it done right, and to fix things that they don't do right and get it straight. So quarterly's pain enough, but
How would you do it monthly, yes, if you cover the monthly?
that'd be about all I did if we did that.
Yeah, it
Well-
costs the city money to do it that way.
And on the general pension, it's gonna cost probably $2 or $3 million a year in returns over time.
I was being,
But
okay.
we'll see. In a year like this, it cost us way more.
Yeah.
Last year, it benefited,
Saved us.
but we didn't do it last year.
It'll cost you.
In a negative year, it benefits you. In a positive year,
In a positive market, it costs you money.
the general pension plan's up over 30% this year through
Nice.
July. So it's costing us money.
Okay, is there any, I'm sorry.
That's asset allocation.
I mean, at least when it's sitting in,
It's earning 5.5% with SBA now, so that's okay.
Yeah, that's temporary.
But that's not over 30%, or here over almost 20%.
The first time the Fed lowers rates, that's gonna.
it's 200 basis below the target.
Yeah, it's below the assumed rate of return.
Is there
And the
any,
reason I'm curious is that over time, maybe the plan manager's into essentially SBA plus 50 basis points as opposed to a fixed schedule, so that the equity and treasury is getting value for lending money or for fronting money to the plan. And then we still can exercise, that you all, the folks that
And-
manage it, can exercise
And we
in
were fine with
disposing
doing
of
that,
assets.
but
Buy
what-
low, sell high as best you
What that
can.
would require is for accounting to keep track of it and, and allocate negative interest to the pension plan, right? If it was a
It'd be
negative
an
cash
interesting
balance.
expense to it, yeah.
And we said that would be the way to do it. I'm
We
not
did
sure
that years ago.
accounting
That's
understands.
how we handed equity and cash across all funds
Yeah.
years ago.
Yeah.
Well, we haven't had to take money out of for police or fire, because at the end of last year, we didn't have a good cash balance.
We had taken a little bit more than we needed out last year because we didn't have financials and we're trying to err on the side of being conservative. So we'll probably have to take money out at the end of September a little bit to keep we have to take enough out to keep the balance positive for the next quarter. So you're not just trying to get above zero, you're trying to do enough to keep it positive for an entire quarter. So, I mean, I've got a cash flow analysis spreadsheet that I use to predict how much we need.
And to make a good prediction,
Yeah,
we've
crystal
got to
ball.
have good actual
You gotta-
trial balance,
you gotta-
accounting numbers. So-
Project out 3 months what you're gonna need.
Yeah, and it's based on, prior quarter benefit payments versus contributions versus expenses and,
Fun.
Just tell those people that draw. Don't.
Well, that's the, I mean, you
Let
can,
us out 3 more years.
you can make assumptions about drop, but people can leave drop with $500,000,
Right, I know. Yeah. That's one of the reasons.
That's the plan.
It's a good plan.
All right. I was just kind of curious, to see if there's a different way to look at it.
I'll do a little analysis on it.
Yeah,
The thing is, we haven't even done it for a full year
I
yet.
understand that, that's why it's
Yeah.
more of a,
Projection.
Yeah.
All right. No public comment, not hearing any. Any further member comment? So our next meeting will be October 11th, 9 a.m.
We'll update the invitations and send everything out.
All right. Oh, yeah, I don't know what we had lined up anyways for other, well, if they can't make it, they can't make it.
We don't have anyone set yet. We kind of set managers on the initial, full year schedule. But then Willis Towers Watson quite often comes along and says, well, how about we do this manager this month? So it ends up changing
Oh, sure.
sometimes during the year from what the schedule says.
And I'm pretty sure my possible successor will be here,
Okay,
and maybe his backup plan.
all right. If he wants to,
Someone at staff usually asks for the nominations. And then if there's an election, the union will hold it. Is that?
Risk
sound right?
management.
yeah.
Handle
Someone reached out last time and said,
Reached out
accepted.
to Melissa Rodriguez.
Is that, okay.
Yeah, you're leaving your term early, right?
I was gonna finish it out. According to Bob, that's
Oh, okay, when is
okay.
your term in?
January, I think.
Okay, all right, so we're early in the process.
Yeah, we're not,
Okay,
yeah,
okay.
I wanted to
I-
make sure, takes a while to get nominations, and I don't foresee an election, but there could be.
So,
Never know.
I mean, we can just tell Sue wants to go.
Hopefully, he'll come to the October and November meetings, and if he ends up being the trustee, at least he'll have more exposure. And I'm trying to get him to the class September. There's one that's 175, 185 one, I think. Bob brought it up, that's what another reason he
the
was saying. don't-
Division of Retirement.
Yeah, the state puts on a free
Yeah, yeah,
conference. We just got, well, the union will pay for his hotel room or something. All right, motion to adjourn is ordered.
Motion to adjourn.
All in favor?
Aye.
Any opposed? All right, awesome, meeting over. Thank you.